Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching. Greatly appreciate all the interest in the channel, the comments, and certainly those suggestions for what to look at next. Thank you so much. Really appreciate that. All right, this channel is dedicated to the rational investor, and what we're looking for is cash flow. Cash flow is how you value a business, period. That is the underlying reason a business stock price moves. And it is the reason, is the way you value a business, is the present value of all future cash flow. So what we look to do here is we use two different methods to value a business for their future value. We compare that to its current price in the market. We look for a difference between those two prices, and that difference is our economic return over time as the market realizes what its true value is. We look at every investment with 5 key attributes. That'd be top line revenue growth, earnings growth, as we define by EBITDA, free cash flow growth, a strong balance sheet, and a well-priced stock. Please see my Google versus Domino's IPO video. It shows what the impact of a well-priced stock can do with Domino's outperforming Google. All right, let's look behind me. I've got Coca-Cola's 10K here for the most recent fiscal year. I highly recommend that you read the 10Ks. They're very informative, and Coca-Cola is no exception to that. Let's dive right into the financials. So what I'm doing here is I've got 10 years of financial information, roughly 10 years of financial information for Coca-Cola. And I have to say, doing this review, I learned a lot about their business. For example, I would never have guessed that Coca-Cola's revenue over the decade has declined. I would have thought that even though soda is declining, that they're gobbling up other brands that are growing. And while they're doing that, they can't seem to offset the decline of soda because it's such a big piece of their overall business. So the revenue was $46 billion in 2011. It has declined to $37 billion by 2019. That is a 3% annual decline in top line revenue. And that's hard to overcome. And being the very first hallmark that we look for a good investment is top line revenue growth. That's gonna be tough. I'm not sure how we're gonna get past that, but we're gonna continue on. We're gonna look at it, but this is surprising. You've got EBITDA here. This is earnings before interest and tax. It's also called operating income. We're gonna add depreciation to get to our proxy for cash flow, which is EBITDA. That stands for earnings before tax, depreciation, and amortization. And what we're trying to do here is represent what the average income is to the business. Again, we look at the business as a whole, and so the income for the business as a whole would be EBITDA for us, not net income, not some of the other line items that are affected by, say, currency change or non-control interest investments, or even write-down sale of assets. Those are all true financial charges and should impact net income and should impact EPS. But if we're looking for the business for a decade from now, we want to know kind of what is the run rate, what is the average steady state operational income. That's an EBITDA of the business, unlevered. And this has declined. This has declined very slightly. I peg it basically at zero growth. So you got top line revenue is declining. They're refining the business and increasing margins, but they're increasing margins to basically zero EBITDA, which doesn't meet our criteria. Let's go through and look at enterprise value and see what the market multiple is saying for Coca-Cola. Debt level's grown from $34 billion to $51 billion over that period of time. They do have excess cash, so you want to peel off that excess cash when you're looking at enterprise value. Market cap, $155 billion to $232 billion over the decade. That is a nice increase. I'm a little surprised to see that increase given decreased revenue and flat earnings. You got to wonder how that's happening. Well, here it is. It's happening by a market multiple expansion as basically everyone's diving into equities. It's driving up demand for stock, so they're buying the stock irrespective of cash flow, which is something you want to be very cautious of. But just let's finish the enterprise value bit. So $186 billion is the enterprise value. 286 billion is the most recent enterprise value as of fiscal year. Again, the calculation is it's all debt, long-term, short-term debt, pension obligations, lease obligations, so forth, less excess cash flow, plus market cap is the enterprise value. And that's what you would pay for the business if you bought all of it, and debt-free, no debt. And then the EBITDA, the enterprise value to EBITDA market multiple, is saying how many years of cash flow, of operating income, EBITDA, does this business need to generate to pay back the investment of the company? And this is saying right now, as of last fiscal year, 24 years is what it would take to pay back on the investment. And I'm sorry, that's just too much for Coca-Cola. If I look at today's price with last year's 12 months trailing earnings, it's 22 times. So it's come down a little bit, but it's not cheap. It's certainly not where we like to see a business like this in the 12 times range. I mean, I get it. Coca-Cola is one of the best brands in the world. I don't expect it to trade for 12 times, but 24, for no growth, flat top line revenue, give me a break. That's way too high. Let's look at the debt. Let's look at the debt piece. So here, their debt is above our mark. So we look for no more than 3 times leverage, right? 3 times being the standard for what a senior bank will lend on a business. Senior bank being one of the big guys, JP Morgan, Wells Fargo, Citibank. Those guys won't lend generally past 3 times EBITDA as a senior lender. If you need more debt, you need to go on to get more junior capital. Here, their debt being mostly a lot of some pension liabilities, some other lease obligations, which is driving them above this typical 3 times levered. So let's review where we are. We've got revenue growth, which is declining. Earnings is flat. Debt is higher than we would like. Those are 3 things that we don't like to see. And smell checking price, I can already tell you the price is too high for us at 22 times earnings. For something that's not growing, that's a no-go for us. But let's keep going and take a look at cash flow, finish the example because I think it's extremely illustrative. So cash flow from operations increasing 1%. That's very close to the flat that we saw in EBITDA. So we're a little counting smell check that cash money and earnings is moving in line is true. So even though it's not where we would like to see it, we know that smell checks that it's accurate. CapEx, so CapEx is what are they reinvesting in their plants, in their factories. This CapEx is considerably less than the cash flow from operations, which is good to see. It means that after cash from selling beverages, they invest in the business, and there's still plenty of cash left over, which is a good thing. Debt, you can see that they've been growing their debt. This is net debt, so it's both debt that's paid out in principal and received. That's why these numbers are positive. And it's increasing, it's inflating the free cash flow from operations. Most of this decade, they've actually increased their debt. That debt has gone out to share repurchase and is a form of dividend, which is kind of manufacturing return for shareholders. It's like mortgaging your house and keeping the cash in the bank account. It's not really doing much for you. It can impact the price, but you're just levering up the business. So I think that's not great reality. Shares, they've been buying back shares. Again, if they're levering up the business, they're borrowing debt and they're buying back shares. It's good to see that they're buying back shares. I'm sorry to see that they're doing it by borrowing. Free cash flow to equity per share, the per share price, and the average yield. Yield of 5% on average is strong. Recently, it's been below that, as you can see, as the market multiple goes up. The share price here goes up, and the cash flow yield comes down. Growth 4.8%, average yield 5. Okay. Now we've looked at the historical information. We've got a good mental picture of what the business looks like. It's decreasing revenue. It's flat EBITDA. Cash flow is growing because they're borrowing and because they're buying back shares. What do we do with this? Let's forecast it, go forward. So I am going to pick up free cash flow, and I'm going to continue to grow it. I'll say they continue to borrow money. They'll squeak out a little margin growth here and there to pay for the extra debt that they're going to acquire, and they're going to grow earnings from $1.61, which is last year's earnings times 4.8%, and they're going to hold 4.0 constant over the decade for $2.29 per share of cash flow. I'm going to give that the average yield 5% for a $45 price target in a decade. EBITDA. What do we do here? Right? EBITDA is flat. Historically, I've kept it flat. Why? It's not my job to push onto Coca-Cola a growth curve. That would mean that I'm paying for my own assumption. I'm not going to do that. I want to build in something that is very, very achievable, and zero, based on what they've been doing, is very achievable. I need a stock that pans out at a zero growth rate for me to buy it, so that if they do grow, it's upside that I get to keep that I'm not paying for. So that means EBITDA in 10 years is going to be $11.45 billion. That's it. And to top that off, I'm lowering the market multiple. This market multiple is too high at 25. Can you see that? 24 times, 25x. For a no-growth company, it's too much. I get the brand name. I drink Coke. I love it. But from an investment standpoint, it's been overbought. So that's going to come down. If you look at what it was previously in the decade, right? 15.5, 19. That's much more reasonable for a Fortune 100 company with no growth. So I'm saying I'm giving it a 17 times out in the future. That means $194 billion of enterprise value. Average debt load plus the cash this time. It'll give me $160 billion of market cap. Now here, I am continuing to buy back shares. They're going to continue to do so, which is fine. Over the decade, they'll chew up more shares, and I have a little under 4 billion shares outstanding in a decade. Divide those, that gives me a $40 price target. So how does that stack up? I've got $45 with one method. I've got $40 for another method. It's currently trading at 47. That's not good. It's actually trading more than the 10-year target. How can that be? I can't explain it. I think I can. I got a theory, but I'm not getting into it just right now. But I think that people are indiscriminately buying names and brands. Okay, fine. My theory is that all this money in index funds, which is basically zombie money, it buys regardless of cash flow. It just buys Coca-Cola's 3% of the S&P 500. You put $1 into the S&P 500, you get 3 cents automatically goes into Coca-Cola, regardless of value. And I think that's driving some of these names that are not producing any cash flow higher because of just zombie money, as I like to call it. But that's a tangent. The point is, let's go look at the IRR here. So I buy at $47. I get the cash flows from my net cash flow over here. I'm out at $42. That is a 4% IRR over the decade. That is subpar. Some people are saying the S&P 500 is going to do mid to low single digits for a decade, given where we are in the cycle and where the market has run up recently. And certainly looking at this, if Coca-Cola, I did Procter & Gamble not too long ago, if these stocks are indicative of the kind of Fortune 100 stocks, we're gonna have lower S&P 500 growth as these companies weigh down the market. So 1.3 times cash on cash, a 4% IRR. If I buy the stock at 47, it says 2%. Hang on, I need to update this. Bear with me. There you go. So if you've got 4% as the current IRR, that price needs to fall to $34 to begin to approach a 10% IRR. That's 9. It still needs to be less than that. But my point here is I think it's overpriced. I think you can deploy your money more safely have better upside, better cash flow protection in other securities. So for this, I'm gonna give it a bad. Right now, I love the company, I love the drink, I love what they do and they stand for, but as an investment, it's a bad investment. It's overpriced and you're not gonna get what you want. My job here is to show you what cash flow is. We use cash flow then to value a business, and this cash flow is not panning out. The market price is right now above what we think the price is gonna be, so I'd stay away from it. My name is Cameron Stewart. This is Rational Investing. Got that one right. Rational Investing. Please comment. Don't forget the subscribe button if you like it. I really appreciate all the comments, the time, the chats. Thank you so much. Bye-bye.